You've just closed on a major property sale in Mumbai, or perhaps you've liquidated a long held family equity portfolio in India worth $100,000, $500,000, or more. The funds are sitting in your NRO bank account, and you're ready to wire that capital back home to the US, UK, UAE, or Singapore. You initiate the transfer expecting it to clear in 2 business days. But instead, you get an urgent email from your bank's foreign exchange desk. The wire is frozen, and they're demanding 2 documents, Form 15CA and Form 15CB. Welcome, everyone. I'm Kunal from EPK Capital, where we build wealth for generations. Over the past 20 years, I've seen hundreds of investors lose weeks simply because their tax compliance was mishandled. Today, I'm going to break down the exact mechanism of Form 15CA and 15CB, demystify the compliance requirements, and give you a bulletproof blueprint to repatriate 6 figure sums out of India smoothly, legally, and without tax delays. To master this process, you first need to understand the distinct roles these two forms play. They sound almost identical, but they serve completely different purposes in the eyes of the tax department and your bank. Think of Form 15CA as your personal declaration to the tax authorities. It is an online undertaking filed by you, the remitter, stating who you are sending money to, why, and whether the required tax has been deducted. Form 15 CB, on the other hand, is an independent audit certificate issued by a chartered accountant. Before the government takes your word for it, they want a licensed tax professional to mathematically verify that every rupee of tax owed in India has been calculated and paid correctly. To put it simply, Form 15 CA is your declaration, Form 15 CB is the professional verification that proves your declaration is accurate. You can think of Form 15 CA as your tax customs form, and Form 15 CB as the certified green pass issued by an official auditor before you cross the border. When you log into the Indian Income Tax Portal to file Form 15 CA, the system presents you with 4 different pathways: Part A, Part B, Part C, and Part D. Selecting the wrong section will lead to an immediate rejection. Part A is for smaller remittances, where the year's total doesn't exceed 5 lakh rupees, about $6,000. Part B applies if you have a formal certificate from an assessing officer. Part D is for specific exempt payments like gifts or tuition fees. Now, if you are repatriating $100,000 or more, whether from property or inheritance, you will almost certainly fall into Part C. Part C applies to any taxable remittance exceeding 5 lakh rupees in a financial year. And here is the rule: you cannot submit Part C of Form 15 CA without first obtaining an uploaded Form 15 CB signed by a chartered accountant. 90% of high net worth foreign transfers stall because investors attempt to complete 15 CA before securing their 15 CB clearance. Let's clarify the exact monetary limits. Resident Indians sending money abroad under LRS are capped at $250,000 per financial year and may attract tax collected at source of up to 20%. However, if you are an NRI or a foreign citizen repatriating capital held in your Indian NRO account from legitimate capital assets like property, inherited funds, or dividend income, you operate under FEMA's $1 million repatriation scheme per financial year. But here is the critical trigger. The moment your cumulative taxable transfers cross just 5 lakh rupees, about $6,000, in a single year, the Indian Tax Department mandates the Form 15CB audit. For a $100,000 transfer, you are well beyond that threshold. The bank's forex desk cannot legally process your wire transfer under the $1 million scheme until both 15 CA Part C and 15 CB are fully validated on the government's e-filing portal. To ensure your wire transfer executes without delays, here is the exact 5-step workflow. First, log into the e-filing portal and formally designate your CA. Second, provide your CA with complete documentation for the audit. Third, your CA verifies the tax computations, ensures appropriate tax deducted at source, or TDS has been paid and uploads Form 15CB directly to the portal using their digital signature certificate. Fourth, you log in to generate Form 15CA Part C using the CA's 15CB acknowledgement number. Fifth, submit the digitally signed PDFs to your bank. Pro tip: always ensure the RBI purpose code matches your bank's code exactly. A single digit mismatch will cause an outright bank rejection. Beyond delays, there are severe tax consequences. India has treaties with over 85 countries. Your CA can apply DTAA provisions to optimize your tax withholding or ensure that every dollar paid in India qualifies as a foreign tax credit. Do not be tempted to bypass this paperwork or submit inaccurate declarations. Under Section 271-I of the Indian Income Tax Act, failing to furnish Form 15CA and 15CB or providing inaccurate information carries a mandatory flat penalty of 1 lakh rupees, approximately $1,200 for every single default. Moving 6 figures out of India is a major strategic wealth realignment. Once your funds cross borders, they are exposed to exchange risks and new tax jurisdictions. The goal is to integrate that capital into your multi-generational strategy. At EPK Capital, we specialize in helping global families and high net worth investors structure their cross-border assets with precision. We build wealth for generations. Click the link in the description or visit epkcapital.com to schedule a consultation with our team. Let's make sure your capital moves efficiently and is positioned for long-term growth. Thank you for watching.